Hi, this is James A. Full Capital, and I got Shamir with Patel Law Group on the phone or on the webinar. So
On the stream.
Shamir on the screen. So Shamir, thanks for jumping on. So before we get going, give people a little bit of your background and sort of how you guys sort of
Yeah,
more about your company as well.
who we are, what we do. Yeah,
Yeah.
so I guess as always, we appreciate the opportunity to be on with you guys. My name's Shamir Soni. I am a managing partner at Patel Law Group in Dallas. I run the multifamily practice at the law firm. Our firm is probably the preeminent multifamily firm in Dallas. We work on numerous deals, on average, $1 billion of deals a year, maybe down a couple of years, last few years. But we represent syndicators, we rep family offices, institutional capital in a wide variety of acquisition, dispo, reorg, restructure, every type of instrument that exists, basically.
Anything that needs to happen.
Whatever happens,
Yeah,
we do
whatever
it.
happens.
So we do construction, we do new builds, we do existing deals, we do A B C D E F G, whatever category you consider you're dealing, we do it, and we do a lot of it. So that's kind of the day to day here. Like I said, all I do is multi.
Okay, so all multi and then all sort of up and down the stack, A, B, C, D.
Yeah,
But so why are people calling you right now? Like what's like the number one thing
yeah,
that people are calling you about right now?
yeah. It's a good question. So, you know, our clients fall into a couple of different buckets. We kind of have our syndicator clients that are a large chunk of, I'd say probably about 60% of who we rep of our clients. And they're calling us about two things. Number one, I need to do a capital call. How do I do it? Can you review my operating agreement? Or number two, this deal's not going the way it should be, and we got bigger problems. How do we need to prepare? Can you take a look at our loan docs? What do we need to
Hmm.
prep for returning this to the bank? And then, the call you really want to get, which is, hey, we found a deal, and we were
That
awarded
last
this
one.
deal. And we
That
like
last one.
that's my favorite call out of those three. And so, what do we need to get in place? So those are the three things on the syndicator side.
Okay.
Um,
What about in the institutional world, family office world?
Yeah, so the family office world's a little bit different. We get more, hey, we're buying or hey, we're selling, which is good. And I think that family office, because the equity is ready to go, they're starting to see kind of compelling value on acquisitions, better quality assets, post 2000 construction, really well located deals. We got a couple of transactions we're working on, which are just they're going to be blue chip assets for a really long time. So we're doing more of that, more family office deals as a percentage. Our syndication deals down, family office deals are up. Um, and outside of that, we're also working through recapitalization type structures on family office deals. So family office owns a deal for a long time, bring in private equity partner, take some chips off the table for the family office, but they still stay in, and they get that uplift in valuation to get those chips off the table. So
Okay, so they're
we're
staying in
starting
the
to do more and more of that.
deal, just sort of recapping it with new equity or
Yeah,
yeah. Okay.
yeah, and I think it's a good way. It's kind of a win-win for all the parties, right? Equity gets into a deal that's historically stable, that's been well run. You're not trying to rock the boat by coming in, but you get in this consistent stream of cash flow and potential upside. And the family is able to take some chips off the table and move into the next,
Next
whatever
deal.
they want to build, whatever they want to buy, whatever's going on. So we're starting to do more of that, and that's been a really interesting place.
On the family office stuff, what are their sort of parameters that they're looking for to step into on a deal right now? Like you can give high level or specific, because that is, I feel like that market is still pretty tight, like in terms of there's a lot of people bidding on these Class A deals. And so, these guys stepping in, I'm just wondering what their box is a little
So
bit.
you're asking about the recap
Not the
partnership?
recap, the
Oh, just the straight
acquisition stuff.
acquisition?
Yeah, the
Yeah.
guys who
So
like they've raised money, it sort of sat there for 2 years, right? Like 23,
mhm,
24, it sat there, and now it's like, okay, now I'm pushing the
yeah,
button to go in.
yeah, yeah. So our our family office clients typically have a much longer investment horizon than our syndicated clients. Our
Okay.
syndicated clients are looking at 3 to 5 years. Our family office guys are looking at a decade plus.
Okay.
So they're willing to be more aggressive on an acquisition for property that is extremely well located. So, think like prime Frisco, prime Plano, prime Las Colinas, really high quality assets that you can have a minus manager on, and that will just consistently kind of turn checks.
Okay.
We're also seeing, because of the tumultuous nature of the market right now, you're having the opportunity to buy deals in locations that may have not been, plentiful in the peak. So
Right.
we've seen a deal in just an A plus location in Houston, that we're working through right now, which we think is, I think it's an absolute, gold mine, and if you can hold it long enough, it'll always improve in value. Um, those sorts of deals, I think, only come about when there's a dip in the market,
Right.
and then you kind of ride those for a really long time, as long as you have the right vision.
So even though like interest rates are a little bit higher and cash flow is a little bit lower right now, they're not thinking like I'm going to flip out this deal in 3 years and I'm
No,
going to
yeah,
hold
and
it
and
for
look,
10 and it'll be there's high certainty that this thing will be worth a lot more
yeah,
in 10 years than
and remember, cash flow is really a function of how much equity you have in.
right.
So
Yeah.
if you put enough equity in, then you can cash flow the
In
deal.
cash flow. Yeah, anything in cash flow with 100.
So
You hope so. You would hope so. Yeah, yeah, yeah.
so
But these are
most of these,
well-run deals, well-run,
right,
high-quality
these are
deals. Yeah,
really
yeah.
stable, consistently, 95, 97% occupied deals,
Okay.
with, they've got rent growth, but I think your buyer is always thinking they could be more rent growth.
Sure. Yeah.
They have, some units renovated. The buyer's always thinking I could renovate a few more. I could do a little more. Um, but they're staying consistently full, which is an important part of this, right? If you can keep your occupancy up, that gives you the runway to push rents a little bit, and you're not super worried about occupancy dipping. Um, so I think that's kind of a big part of it. And if it's well located, you can bank on that to help you keep occupancy really stable.
So I want to go back to one of the things you mentioned on the even syndicator side, just in terms of loan agreements and what you're seeing. Let's maybe start bridge and then go into agency.
Yeah.
So on the bridge loans, obviously a lot of bridge loans got done 21, 22. Now they're
Hmm.
coming due, extensions. What's the latest sort of on extensions?
Yeah.
I think we're hitting the second year extension now
Yeah,
on
we're
a lot
starting
of
to hit.
deals.
Yeah,
Yeah,
no,
yeah, we're getting to the
we're
second
starting to
year.
get into like a real crunch time, right?
Yeah,
So, um, I think most of our deals will try. Every bridge loan is designed to. It's a bridge for a reason. It's
right.
supposed to bridge you to agency.
Yep,
So, everybody wants to try to get out of that bridge debt into agency. Now, some of these deals size, some of them don't. And so, for the deals that size, you know, you do the app, you go through the process, you move to an agency loan. I think there's some conversation now about, do you go fixed, do you go variable?
that's
That's
a
what
whole
you're
different
the
conversation.
professor of. So I leave that call to you, and I think that call kind of changes just given what's going on with rates, right? I think
Right.
right now it's a little wonky. Um, but for the guys that cannot move to a bridge loan, cannot move to an agency
Agency.
loan and are
Yeah.
stuck in their bridge product, we've seen a few different things. We've seen a little bit of bridge to bridge refi, which is not optimal, bridge to bridge plus pref type
Right.
refi. Um, we've seen bridge to short term bridge plus pref followed by an application to HUD. So it's like a bridge to HUD,
Yeah. Yeah. Yeah.
um, which is not terrible in the right situation, but it's really got to be the optimal set of circumstances.
Yeah.
Um, you know, I think you've seen, and I don't know this is going to last for a long time, but we've seen a lot of HFC, traveling HFC, um, driven refinances and reorganization to free up that extra cash flow. Um, when you have the tax exemption, which is obviously a whole different podcast,
It's a
for
whole
you.
yeah, that's a whole different one.
that's
Um,
an hour long for another day. Um, but arising out of that, kind of ancillary to that traveling HFC structure, we've started to see more local HFCs become more active
Okay.
for two or three reasons. Number one, um, people are now more aware of how the HFC program works, right? You've seen it on the traveling side, or you've heard about it on the traveling side. You know, you understand how it works on the local side because they're fundamentally it's the same law.
Right. Yeah,
Um,
yeah, similar.
Second of all, the locals are getting more aggressive about doing deals because they may have lost deals to a traveler or an out of jurisdiction HFC previously. So the local jurisdictions are starting to become more deal savvy about, okay, well, if I do want to do this, I've got to be a little bit more aggressive with the terms that I'm offering.
Yeah,
Um,
the more competition, the more aggressive they have to be, right?
yeah.
Yeah, yeah, yeah.
So we're seeing more of that, and I think on the third part of that is I think bridge lenders and lenders more broadly are becoming more and more comfortable with the HFC program now that it's had its day in the sun, right? I mean, everybody knows what it is, everybody knows what it does. If it's not an HFC, is it a chodo? Is it some other form of like affordable restriction that allows for a tax abatement when your property taxes are probably the largest single expense item in your budget.
Yeah,
Um,
by far. Yeah.
and so,
Insurance was catching up there for a second, but
yeah,
I think it's calmed down a little bit.
insurance is trying, but
Insurance is trying its best to get.
but the appraisal districts are just you can't shop those guys. You can still shop insurance.
Yeah,
Um,
yeah.
so that's the third component, right? So um, we're seeing kind of the HSC program and the affordable housing programs more broadly have their day in the sun, and I think that's going to be one of those things has helped and may help in the future bridge borrowers trying to figure out a way out of whatever they're in. Um,
Yeah, I mean, yeah, you mentioned sort of bridge to bridge plus pref, and I think bridge lenders have been okay with pref, right? But then talk about just pref in general, right? Because I think a lot of people they sort of go out to LPs and they're like, "Hey, uh, we need $1 million or $2 million, whatever the number is, depending on the size of the deal."
yeah, like
And yeah, but
private
then
credit
yeah,
private credit for the last like couple of years is really the poster boy of like private equity, right? Like the private equity guys that weren't putting their money into deals were basically trying to do private credit and
okay,
generate their alpha through private credit.
yeah,
And there's a couple of reasons for that, which we can talk about. But fundamentally, like if you lend to a bad deal, you're kind of hedged both ways, right? Either you get your money back and you're getting these like outsized interest returns, or the deal goes to, it doesn't work out and you get the deal back, and now you've got this deal that you've taken over at a discount. So, a couple of different options. Typically good for the lender, bad for the borrower. Um, on the
So
private
have you
credit.
seen those pref equity guys come in and just pay off that first mortgage, or what are they doing with
No,
that?
no, no,
No.
no. Because they typically like they'll have if you're doing pref equity behind a bridge loan,
Yeah.
then they'll have a changeover provision where they can basically take over the debt if they put in a substitute guarantor.
Okay, so
So when you're talking
they're
about
taking over they're just taking over the
yeah,
deal,
yeah, and
assuming
there's
the
some
loan.
shops that are
Yeah.
doing that pretty aggressively. In fact,
Okay.
like there's some shops that are being very creative about that and being more aggressive and leveraging a combination of their senior rights in a pref with potential affordability, you know, restrictions that you can place on the property to generate value. Like
Hmm.
if I can save myself property tax after I take over the property, then
Right.
maybe I've rescued this property and I can pay off my senior. So there's some things happening in that space where even the pref guys are getting more creative
Right.
to
Okay.
ensure that they can rescue these deals. Um, but over and above that, I think more, pref as a whole, was really popular for the last couple of years. I think that's starting to slow down as those pref groups start to come back on the equity side and want to
Okay.
buy deals.
Yeah.
So I think that's this it's the same money, it's just coming out of different pockets. So
Yeah.
you're gonna have to deploy differently. And so we're seeing some of that. We're also seeing the cost of pref come down. I mean, for decent quality deals, we're getting out of the double digit pref.
Hmm.
Like we're doing a deal right now, which is not a double digit pref and is a very manageable current pay. And I was like, okay. Like
So it's like
this is
half and half. So like let's say
no, not
nine.
even half and
No.
half. Actually, this
Oh,
deal is like better than that, and it's an
okay.
institutional group. It's not a troubled deal,
Right.
but
Yeah.
there's a agency assumption with a pref, and the pref terms are good, and our guys will everybody's going to do well. The pref guy's going to do well, our guy's going to do well, and it's going to be a good deal. Which you know historically over the last couple of years, it's been the pref guys are going to do really well, and the sponsor's just going to scrape by.
They're just trying
Uh,
to stay in the deal as long as they can,
yeah,
right? Yeah,
like
yeah.
it was a little bit more predatory. It's not so much the case right now. So maybe we're seeing a shift in sentiment as we move towards a private equity market instead of a private debt market.
Right.
Um,
Yeah. Instead of being because on some of these deals right now, let's say on the nicer stuff, you get 55, 60% agency loan on it.
mhm.
And then you want to add like that 20% slice of pref in front of the common.
Correct.
And then, yeah, if you're paying them only 10%, then that's accretive to your LPs
To your comment,
on the deal.
correct.
Yeah, yeah, yeah.
Yeah, and I think that's so I think in the long run when people look at what went wrong, and we can talk. This is again a whole another episode, but what went wrong over the last 5 years? I think the analysis on the LP side of the entirety of the cap stack, if you're tossing in a pref or negotiating a pref in the last few weeks before you close a deal, your LPs really haven't had an opportunity to take a really deep dive into what that deal looks like with the
Yeah.
pref.
Yeah.
Um, and so I think one of the lessons learned is like, for LPs is really have a robust grasp of what that capital stack is going to look like early and late. And there can be multiple models because sure things evolve,
Yeah.
but you've got to have a robust grasp of that because those deals that did take pref last minute are typically taking pref last minute for a reason.
Is that so? Okay, I'm not an attorney, you're the attorney, and you can say
Yeah.
this is not legal advice and contact your attorney, but so let's say, okay, so on deals today, let's
Yeah.
say you're raising that $20 million in equity, but then you go out, you get 15, and now you're like, oh, I need that extra five. I got to close in
Yeah.
2 weeks or 3 weeks or
Yeah.
whatever. Then do
Are
you
you
got to
allowed
go
to?
back and
Mhm.
tell all the
Yeah.
LPs, hey, there's a 5 million in front of you guys. Now it's only gonna be 15
Yeah.
because your original presentation probably didn't have
Yeah.
it in there.
100%. So when we have that come up, so we have that come up once in a while right now.
Yeah.
And Chris Barsness, who's my partner that runs our securities practice, we have a very clear line of demarcation that if we're in any way materially altering the economics back to the investors, you need to do a supplemental private placement memorandum, um, and potentially get consent from the investors to amend your operating agreement, and you have to give them a right of rescission if because now the offering has materially changed from what was
Changed.
originally
Sure.
offered.
Okay.
So yeah, on our end, like we run that very very carefully because I feel like that is a major area of like risk for
Right.
everybody, including
Yeah.
our clients.
Yeah.
Um, I think different attorneys have different opinions on that,
Okay.
but I feel like our opinion's right. So
So, so you'll be at the conference in October,
yeah.
speaking through all the changes and what you're seeing out there as well.
Mhm.
So we appreciate you coming out to that in
Yeah, we
October.
appreciate always
Yeah.
appreciate the invite. You know.
And so, but before that, this will probably go out this week.
Mhm.
What's the best way for people to reach out to you if they have a question on any of this, whether it's structuring PPMs or they're buying or selling? What's the best way for people to reach out?
Yeah, absolutely. So the best way to reach me is by email, ssoni@patellegal.com, or on our website, patellegal.com. As mentioned, kind of I run the multi-practice. We're a full service law firm. So I run multi. I have a partner who's been practicing 23, 24 years, who runs our securities and private offering practice, fund formation. And we do a lot of that again across the value chain. So both at the syndicator level, at the family office level, and then at the institutional, you know, international feeder fund tax conscious, super complicated structure that I don't even understand at this point. We do it at all the tiers. So we do a lot of that stuff. Well, Chris does a lot of that for at our office. Um, we also have I have a partner that runs our estate planning practice, which the asset protection part of our law firm's really taken a step forward in the last couple of years as our clients started to become more aware of like deals go up and deals go down. So
Right.
you want to be conscious of what asset planning and asset protection, estate planning looks like early, so that you're not reacting to it when maybe things don't look so great. So that's another big part of what we've done at the firm, and Anish has been doing that for a long time too. So we consider ourselves an entrepreneur first firm, and our real estate entrepreneurs are just like all of our other entrepreneurs. They need kind of the full suite of services, and we're happy to bring that to bear.
All right. Well, appreciate you coming on, and we'll see you in October.
Awesome. Thank you so much, and
All
look
right.
forward to seeing everybody then.
All right. See you. Sure.